what do VC firms do? They, once again, they're raising, they're going to deploy, they're going to choose good investments, they're going to increase the value of those companies in a variety of ways, which I'll cover soon, and then hopefully they're going to exit that and make their LPs money, and then raise more funds, and then do it again, and again, and again, right? So, in that case, a lot of VCs out there, it's not all one strategy. Different VCs have different strategies. Some VCs might be industry focused, more biotech focused ones out in Boston. Over here we see software ones, right? There's also going to be VCs that are focused on certain stages of a company. There's going to be early stage VCs, there's going to be later stage ones that are focused on doing the bigger, towards the exit deal. Each of them have different strategies, so it's really important also to target the right VC that's doing deals pertinent to the company that you're at, right? If you're a biotech fund, you're not going to go to a consumer-based VC to raise money. That doesn't make sense. That's not what their expertise is in. That being said, through the lifetime of a fund is something that we need to pay attention to because you want to approach the fund at the right time in their life cycle. At first, every fund is going to need to fundraise. They're going to the LPs. That's when that period of time is called an open fund. The fund is open, they're looking for commitments, they're raising a fund. And it's interesting because at my seat, I not only work with venture capital funds and private equity funds, but I'm also working with startups. And everyone has their struggles. VC funds struggle just as hard to raise their fund as a startup might in raising money for their company. So during this time, the first 3 to 4 years of this fund is when they need to deploy what they've raised. The reason for that is every fund has a limited life cycle. So in doing so, they need to make sure that that fund is deployed and they find all the companies, all the startups they want to invest in that first part of their fund life cycle. From there, it's monitoring. They're going to add value to those companies. Just yesterday, I was in the Bay Area. I met with Catalyst Ventures, and something that she said really stuck out to me in that what they want to do, there's different types of funds. Some funds are very hands-off with their portfolio companies. They want their CEOs to do their thing. They're hands-off. They want, they want them to work on their own. There's some VCs that are very, right? They'll put in a board member usually. They might have weekly checkups. They might even put in advisors. Sometimes they'll pick up the phone. They'll make connections for their portfolio companies. They will, make introductions to strategic investors. There's a lot of ways that a VC can add a lot of tangible value to their portfolio companies, and that's something also as founders that you need to think about. How involved do you want that VC to be, right, at this monitoring stage? But at the end, it's with the goal to exit the company. And an exit can be in a variety of ways. It can be an IPO, they can get acquired by another firm, it can be bought out by a private equity fund, right? So there's a variety of ways, but at the end, we want to return that capital to their LPs. And the lifespan of a fund is 10 years, typically. Which brings us to an important term here, dry powder. So a dry powder is the amount of capital that is left in a venture capital fund. So if I was a VC and I raised a fund of $100 million and I invested $10 million of that into company A, I have $90 million left of dry powder. That is the amount of capital I have left to deploy into those companies. So entrepreneurs, if you're going to be targeting a VC,
I'm going to have to give you that.
you're going to want to make sure that they have dry powder available. And usually, remember, they have to deploy that within the first 4 years of the fund. Does that make sense? Okay. So if that makes sense, we're going to do our next swag quiz. What would be a good vintage year? Now, the vintage year is the first year that the fund deploys their money and then makes their first investment to use when searching for a fund that is actively investing in a company. Well, you got to raise your hand so that I can choose somebody.
2008.
There you go. Good. That's right. Because in 2018, if they made their first investment then, that means that they have 3-4 years, right? Yeah, 2 years to invest that fund. It's a perfect time to approach that fund because you know they have to deploy that money.
Would you still rather go to a new fund with less experience or to a more experienced fund with maybe less powder?
I think ultimately you want to go to a fund that's going to be the best fit. Yeah. So she asked, would you rather go to a first-time fund that has no track record and has never deployed any form of money, or would you rather go to a VC that has a little bit of dry powder? So I think, again, the question is, if that first-time fund has founders of that fund that have exited multiple companies before, that have worked at a corporate investment bank, or whatever it might be, and they have the track record, that's your better bet because they have money, right? Versus if you go to a big one that doesn't have money, it doesn't matter how good they are, they don't have money, right? So it's something to think about, and it's kind of up to you. Next question. So, yep, that's 2018. First few years are probably looking for investments at this time. The next one is, what's the average investment period in a portfolio company for a venture capital fund? You got to raise your hand so I can pick you. Okay, go for it.
10 years?
10 years, all right. And you guys could pick a prize, too. You can come up while I do this. Now, that's right. So it's actually 4 to 7 years. It's not, but at 4 to 7 years, that's usually how long it stays in a portfolio. 10 years is the life cycle of a fund, right? So it's during those 4 to 7 years is when they want to add value to that fund. Which brings us finally to why you guys are all here. Now that we have the fundamentals aside, we can talk a little bit about what the trends are looking like in the United States. The first takeaway here is that last year in 2018, it was the largest, most massive year we have seen in venture capital. $138 billion last year was deployed by venture capital funds. That is the highest we've seen since the dot-com era. This year, we're very much on track to do the same. Additionally, with the increase of funding in the space, valuations have also ticked up quite a bit. So to keep in mind, a lot of this, is driven by the excess amount of money that's out there. LPs, remember, at the top level, those institutions, last year there was a little bit of volatility in the public markets. We saw the trade war with China. We saw anytime a tweet happened, the markets went crazy. Rumors of a recession. All of this had LPs actually diverting a lot of their capital into the private markets. So with that, we saw a ton of funds being raised as well. $57 billion of funds were raised last year, and this year still quite a few new funds. With that, the capital overhang is a term that's going to be really important. And this is probably one of the most pivotal points of this presentation. We talked about dry powder, which is the amount that is in each fund. If you sum that across everything, that is the capital overhang. So if I took every VC fund out there and I took all the money that they had and summed it together, that is capital overhang. Now, remember, these fund managers have to deploy that capital in a certain amount of time. Because if they don't, then they really just had one job. Their one job was to find startups, right? So if they don't do it, then they failed at their one job. This slide is probably my favorite one. We are at a period of time right now in history of the highest capital overhang out there. $118 billion currently is sitting in funds. So what does that mean for you? That means right now is a really good time to be raising money for your startups because there's a lot of money, record amounts of money out there that has to be deployed. Otherwise, it goes back to the LPs, right? Now, there's also implications to this. When there's a lot of capital overhang, that means there's more competition for good deals, right? A lot of these VCs are going to be competing, bidding things up. You're going to see valuations going up, which is what we saw. We're going to see some hasty decision-making sometimes, too, because they need to deploy that capital. So these are things. So stared at that slide for long enough. Raise your hand. How much capital overhang is there currently? Yeah, in the back right there. Yeah, and why is that notable? We could split this into two questions, I guess. Go for it. Why is that notable?
It's the highest that it's ever been.
It's the highest that it's ever been. That's right. And that means there's a lot of money out there for you guys. Great. And you guys can come up and grab your things whenever you want. Now, it's more money for you. That's the answer there. It's an incredible time to be a startup, but at the same time, it could be a little scary because this year we saw a lot of unicorn companies, right? So who knows what a unicorn is? $1 billion, so excessively high valuation. We saw a lot of those, and you see in 2019, a lot of IPOs happened this year, but not all the IPOs were that fairy tale ending of IPOs, right? As we can see, this chart was actually released this morning from PitchBook. So we tracked a couple of the notable ones here. They indexed it all to, they normalized it all to 100 and indexed it. And we could see at the time of their IPO what happened, right? Some of their stock prices went down. Over the summer, it got really heated, right? Some people probably made a ton of money, but then it all kind of went down. When WeWork filed their S1, right? The entire saga of that, which I'm not going to go into too much, but just know that the market, at this point, investors, I feel like, have found that dislocation between the public and private markets. The valuations are no longer really at par, per se, and not all of these companies here are worth what they once were in the public space. Yes?
Are companies like WeWork, these unicorns that are, still getting $1 billion in investment, are they competing for the same capital in that overhang that you were talking about?
So he asked, are the unicorn companies that are raising capital still competing for the same money that's in the capital overhang that we saw? I think that's a really good question. I think that there are some really large funds like SoftBank, right? The Vision Fund, huge funds that are deploying huge dollars into these companies. Your company has to be at a certain size in order to even be considered to have that big of an investment. In the case of WeWork, they raised a huge round right before that IPO, the filing. So I think there's only so many companies that would really qualify at this point. But in the overhang, that money's good for anything, right? It's a mixture of small funds all the way to the big funds. So I guess the answer is yes in that case. So interesting time, and that brings us to our next quiz. Which VC-backed company had an IPO in 2019 and currently has a share price that's actually higher than the price in which it IPO'd at? You have to raise your hand because... Yes. No, wasn't Slack. Yeah. It was DocuSign, Seattle-based company. If we go back to that, you can't really see it too clearly, but DocuSign's that blue one right there at the top. It is one of the only ones that, yeah, it's like all the way up there. Good. So DocuSign, Seattle. So speaking of Seattle, that brings us to the next section of the presentation, which is venture capital here in the Pacific Northwest. The upper left is doing well. There is just as much money. It's following just the same trends as the rest of the country. This year, we're on pace to exceed last year, which is huge. $3.4 billion. Most of that actually is going to be in the early stage. The top VC deals this year topping the list, Remitly, right? Down there, Sana Biotechnology. And you can see these are all a mixture of industries, too. It's not just software. It's not just healthcare, right? People call us the cloudy city, but it's not so cloudy. There's other things here. Which, really quickly, just so you sound smart at a dinner party, what does Remitly do? Yeah. Yes. It remits money to foreign countries, okay? It's a good thing to know. $220 million this year. That is one of the largest deals, that we saw this year. They are a remittance company that remits money to foreign countries that allows people to do that, consumers. Now, deal sizes here in the Pacific Northwest, however, are still smaller than the rest of the country, except at the angel stage. Angel stage, pretty much on par. You can see they're close. The lower line is the Pacific Northwest. But in a slightly earlier stage, those Series A deals, the deal sizes are smaller. And at the later stage, they're much smaller. So what this implies with smaller deals on the valuations is that valuations are going to be lower, right? So what I did here was I took the data of all the companies in the Bay Area that raised and plotted them against Seattle, because I've always said this, like anecdotally, that we have, we are better priced here in Seattle, but here we are better priced. We are at not a discount, or not even a discount. We're like at a normal price that startups should be at. Our valuations here are not outrageous across all stages. It's not just early, but especially at the later stages. Those big deals, our valuations are way more lower. And that's not a bad thing at all. Low valuations aren't bad. If anything, it's realistic, right? You can think about it that way. And that, again, feeds into the whole unicorn situation that happened this year. Now, the early stage, for you guys in the room, early stage deal volume is looking amazing. It looks strong here in the Pacific Northwest. Continuing, and a lot of that, once again, is made up of early stage deals. These top investors here in Seattle, a lot of these names I'm sure many of you will know, and they are reinvesting back into the ecosystem here, right? So in terms of the software, it's still dominating in terms of just dollars, right? But when you see this graph, it's nice to see all the different industries that are at play. And what makes Seattle special, I think, is that we are at a cusp of many bigger companies that are headquartered here. We have Microsoft, we have Boeing, and together you have space tech that happens here in Seattle, right? We've got newer Amazons with retail too. It's not just software and cloud. And I think with that, it's really, really encouraging to see all the different companies that are getting started here. Now, that last question, I think it is, name 3 of the top 10 Washington-based companies that raised VC funding this year by deal size. Okay. 3 of them. This is kind of hard. Go for it.
Remitly.
Yes.
Icertis.
Mm-hmm.
And said,
The 3 is what's really tripping people up, huh? Here's the top 15 companies, right? And once again, when you look at it, it's across all different things. There's cybersecurity, we have marketing, tech, life sciences, I know, right? So High Spot is one, ZipWhip is another one, right? Outreach, 3 companies that you wouldn't peg to be a Seattle company. They're marketing tech. Right? But that's why it's awesome, because we have that variety here, and we have the investors and the capital to support that type of industry. And since we have time now at this point, I'm going to go to my favorite topic, which is the female founders topic. So how many of you in here are female founders? Excellent, good. How many of you know a female founder? Yay. How many of you work with a female founder? Amazing, good. There's a lot of negativity surrounding women in venture capital, and there's been a lot of negativity surrounding this topic for a little while now. But instead of using the remaining of my time to dwell on that, let's talk about the good things out of this, right? So this last year, 22% of our VC investments went to companies with at least one female founder. That being said, we are currently living in the highest point of time of all the companies that are being founded by female founders. And that's amazing, right? And this year we're set to exceed that once again, not only by dollars, but also by companies that are being founded. There's equal capital that's being invested across all stages of female founded companies. And then also you can see the brunt of that is actually in the earlier stages. And then there's significantly more early stage deals that are happening here. And it's those early stages that actually really matter a lot. It just takes one person to believe in a founder or to believe in a vision and to be able to have them execute that. So I think that's very telling. The University of Washington here on this campus, according to all the data that we have and the number of founders and the number of entrepreneurs that are put out from this school, you guys are in the top in terms of undergraduate founders, MBA founders. This is across all universities across the world that are turning out founders. So you are at a great place in time. You're at a great place in general, this school, and you have incredible resources that's allowing you to do that. And then one final thought that I'm going to throw out there is that I'm really excited to announce that Seattle is ranked number 6 in the number of female co-founded companies. So this city in and of itself, yes, we're going to be behind San Francisco and New York, obviously, because they're bigger. They should have more female founders, right? But look at that, right? That is something to be super proud of, that we as a city we're number 6 in this nation. And with that, we are also, 6 in just the number, not just dollars, but number of companies that are being funded and founded here. So the main takeaways, once again, is that 138, there's a ton of money, $138 billion of VC capital that's in the space. $118 billion of capital overhang out there right now. It is a phenomenal time to be raising money as a startup. And then finally, we are number 6 in the nation of female-founded companies, which is something to be extremely proud of as well. Seattle is a great place. A few years ago, people said that there wasn't enough talent. But now, you know, every major corporation is rushing to be here to build a presence here in Seattle. Our skyline is changing every single day. We have institutions like the University of Washington, like CoMotion Labs. We see accelerators popping up, and there is no better place or time to start a company than here. So I am extremely honored to be here. I am extremely excited to see what comes out of this lab. And thank you so much for having me. If you didn't get your prize yet, you should come up and grab it. It's for whoever answered the questions right. Great. Yeah.
I have a question.
Mm-hmm.
So I think that PitchBook data is really seductive. You can get in there and you can stay for a very long time. And I'm wondering if you were going to advise someone to look at 3 things specifically, if you were limiting them to the 3 most important factors or salient details regarding their research, what would it be if they're trying to check out this space, if you could do that?
Yeah, so in terms of fundraising or in terms, okay. So her question was, there's so much information in PitchBook that can suck you in. What are the 3 most important things to take out of PitchBook if you were using it? Dry powder, absolutely. You don't want to go to a fund that doesn't have money. They're going to invite you to pitch them anyway, just because. But if they don't have the capital to invest in your company, there's really no point. I think also competitive intelligence. You need to know what other companies are out there that have either raised already or that are planning to raise. That's really important because then you'll know how to phrase that conversation. How do we differentiate? Where is this company? Are they even doing the same thing that we are, right? And then lastly, I think it's important to see other VCs. So you might have your eye on a VC that you think is perfect, right? But they might be co-investing with a lot of other venture capital funds too. So just keeping your eyes open for other alternative investment sources, I think is going to be a good use of PitchBook. Mm-hmm. Yes.
So I'm wondering what your definition of VC is, just for how to think about the data, because I noticed that you have Alliance of Angels that doesn't actually make investments because their members do. So because you can get statistics on it, you have to look at the data a little bit differently. But you also don't include some of the evergreen funds like WRF that does make investments, but since they're an evergreen fund, they don't have the same sort of closed-ended fund structure. Of course, Alliance of Angels doesn't either. So.
I think, and my research analyst back there can correct me if I'm wrong, it needs to have like a set fund structure and be deploying that into VC deals. Correct? Is the definition?
Correct.
I think so. Okay. And so with that, like obviously there's going to be some like angel groups that might be filtered out at certain stages of.
So it seems like Alliance of Angels wouldn't fit that definition, but again, for example, WRF would, so I'm still confused. But
So I'm from WRF. Hi, Sandy. And WRF has actually invested in more university startups than any other VC fund in the state ever. So just so people know, WRF Capital is here. We want to see your startups.
Yeah, and they're great too. They help a lot. Yes.
How do you get your data? And then are there some funds that don't expose it?
That's a good question. So at different levels, there's different ways of which we're gathering this data, but the main answer is we're going to get anything that's publicly available first. So if there's a news release, a press release, government filing, anything. From there, it goes to our research team. So we've got 1,000 people around the world. Their job is to reach out to the fund. They're going to reach out to the startup. They're going to reach out to the law firms that worked on the deal. And they're going to confirm everything that we find publicly, and then it goes into PitchBook. So it's a pretty manual, tedious process. If, of course, a fund doesn't report things to us, like we can't force it, right? And we're not going to make anything up at that point. But it's in everyone's best interest ultimately to report, just because so many people are using PitchBook. So many startups are using it to fundraise, so they want to make sure their data's right. so many investors are using PitchBook to find startups, so they want to make sure that all their data is right when they're in there. Ultimately, it's just to make sure that it's coming from a source. Yeah.
With such a large overhang in the venture capital market, do you have any details on what's going on the private equity side?
That's a good question. So,
It's super competitive now.
yeah.
Great deals in private equity versus venture capital.
That's a really good question. So he asked, with so much overhang in venture capital, what does that look like in private equity? It's the same story. Private equity funds are a little longer in their life cycles because the difference, real quick, between a private equity fund and venture capital fund. Venture capital fund does early stage startups. It's more of like a bet, if anything. A private equity fund goes into an already operating company that has cash flows. Like they're making money, right? And they're going to go in and they're going to buy out that company. They're going to put in some operational executives maybe. They're going to fix some things. They're going to remarket everything, rebrand, maybe even make things more efficient. And then they're going to try to sell that off in a few years to make a lot of money, right? So that's the difference between private equity and venture capital. Now, with private equity, we still see that same overhang currently. I don't have the exact figure off the top of my head, but it is still larger than ever. And it is also a little more alarming just because their transactions are much bigger typically because they have to buy out that company in whole, right? So in terms of like what we're going to be seeing in the future, I think if we are to enter some form of a recession, we're going to see a lot more private equity activity because they want to get things at a deal, right? They want to go in as cheap as they can and sell it for as high as they can. So that's the general trend that we're going to be expecting to see on that end. Yeah.
As they grow it.
Yeah, they're going to sit on it and fix it, and then sell it when valuations are higher again.
So, as the WeWork debacle has unfolded over the past month or so, seems to be a lot of effects in the late stage market. Have you seen anything in the data to indicate that early stage investors are changing their behavior at all?
Yeah, I think that quite a few years ago, it used to be all about the founder, right? If there was a founder that had done really well, then everyone in Silicon Valley kind of got on board with that, right? But now I think it's become much more about the actual economics. You know, what do you have revenue? Like, what is your addressable market? Are you guys actually making amends, in that market? There's much more specifics that are being looked at versus more of like a general, a Theranos situation or like a WeWork situation or, and I think that's really at the earlier stages, it's actually getting a little more competitive. Now, that being said, with all this capital that's in the space, VCs are getting more competitive about the different deals too. They want to make sure that they're in on everything, but at the same time, you don't want to inflate the valuations of these companies too much, right? In the same way that some of these later stage companies are. So I think it's going to be much more cautious going forward. At least that's what I've seen also on a personal investor level. People are a little bit more and more cautious about what they're looking at. Yeah.
Is PitchBook available for anybody to use? What's kind of pricing for someone who just wants to kind of go and take a look?
I think the university, there's agreements with the University of Washington through your library, I believe. Yes? Okay. Yeah.
And actually, hi everybody. If you are a student on campus, Foster Business School is hosting a How to Use PitchBook session on, I think, the 11th or 12th of November, the 12th, from 5 to 6 at the Foster Business School Library. So again, for students only, but that's a great way to be able to dive into the data because that is a huge resource that you have while you're a student on campus.
Yeah. And if you're not a student, it's a little more expensive. And we can talk about that if you want to. Offline. Yeah.
I hear that unpriced deals are convertible debt, other priced deals are very popular right now. Do you get statistics on that? Do you think it's true, and do you think it's related to the size of the overhang?
I don't know if it's related to the size of the overhang. I know that on the convertible side, like safe notes and whatnot, it's really easy for founders. There's a lot of founders right now, you don't want to spend so much time, money on lawyers, to draft up like an official equity round. So I think that option is just like an easier way to go, and I think we are seeing more of them. I don't have statistics on that. I can get back to you specifically, but I know that we do see quite a few more of that, and I would guess it's more so on like the founders level, right? It's much better for the founder to do a safe versus a Series A, right? So.
Can you elaborate a little bit on the valuation slide? Why were valued so low? Is it because the companies are smaller, or the VCs here are valuing the companies less?
That is a really good question, actually. Valuations are going to depend on both of those things, right? It depends on the amount of equity that the startup gives to the VC. It depends on the round size. It depends on also if they have cash flows, right? If they're super, super early stage, likely there's probably no revenues yet, right, at all. If it's a later stage one, then of course that's when it's going to come to some valuation firms to be looking at that. They're going to be able to value it on their own terms. I think in this case, overall, the deal sizes are smaller here. And because the deal sizes are smaller here, we can assume that the overall deal and the overall valuation of that company is going to be smaller. Now, the thing about this slide that I'm going to preface, though, is I split it up into 3 different sections, right? On early stage, on normal, and then on later stage. Because if you mix up all of those different stages, it wouldn't tell an accurate picture, right? You can't compare a Series A to a Series D, and you can't compare the size of those deals relative to each other too. So at each of these stages, when you normalize it that way, we are still just overall through time valued lower than the Bay Area. And I want to say my point here is that the valuations in the Bay Area are just higher, right? It's just a little bit more I don't want to say inflated, but inflated. Yeah. Yeah, it's the Bay Area. Exactly. It's more expensive there. It's just more expensive. Things are more expensive. Versus here, we have great talent too. We have incredible talent. We have all the engineers you need. We have all the institutions, the hospitals, the schools that one would need to create an incredible company. You might have a competitor out in the Bay Area. That is your counterpart, right? But that means that you have a good company. It means you have a good idea. It's validated, if anything. I feel like at a couple of the talks that I do, there's always a question of, oh, there's another competitor in the Bay Area that's doing what we are doing. Like, what do we do? And it's like, well, keep doing what you're doing. That means if you have a competitor, it's you're in the right space, right? So. Any other questions? Yeah.
I was wondering, if a company or startup here, I'm raising fund, why don't I just go down to Cali to raise funds?
Right? Right? That's a really good question. So, anecdotally, what I've heard, there are companies like, for instance, Box. Do you guys know Box? Okay. They started here, I believe, and then they were also in the Bay Area. But they actually moved their entire thing to the Bay Area to build and to raise funds. And I think what the founder once said, I remember in like a podcast, he said that, they all thought like, oh, why did you come down here to San Francisco? You couldn't raise money in Seattle, right? And I think that's like the whole thing is that they think that, oh, in Seattle, if you're in Seattle, why don't you just you couldn't get money from Amazon or Microsoft? It's like, no, that's not how it works, right? We do have funds here, with not nearly as many and as much capital as what is in the Bay Area. But at the same time, you need to keep in mind it is more expensive to have a company to do that, right? And you might be valued at way, way higher, and they might take a lot more equity than you are willing to give up than being here, right? So there are trade-offs, absolutely. And I think as a founder, I'm not supposed to advise on that, but I'm just showing you the numbers of what the reality is of how these companies ended up.
Yeah, I guess from what you just said, looking at these valuations, do you have like a rough breakdown of, okay, so yeah, it was valued at 23 million, but I mean, that's only tells part of the story because you don't know how much the founder actually keeps after that. So do you have any information on that? Do you tend to see in the Seattle area they take less company, but I mean, that makes sense why the valuation is lower.
Right, yes, that's what's driving that.
Okay.
Mm-hmm. And in PitchBook, one of the pieces that is really proprietary is we have cap tables of all of the deals and companies that have been raised. So you could actually go down into, okay, of all the Seattle Series A companies and biotech that were raised, what percentage at the Series A was given up to an investor? What was the median percentage at a Series B? You can compare that if you wanted to the Bay Area. And I almost guarantee you that percentages will be higher in the Bay Area.
That's what's driving the valuations.
If some of these companies are private, how are you getting this information?
So once again, we're getting anything that's publicly available first, and then we're going to reach out to the individual parties one at a time, whether it's through a survey, whether we're going to call them. We have a giant research team that's bigger than, it's most of our company actually that's gathering the data.
It's a good question. It's not easy to get the information. Yes. Okay. Okay.
Of the companies that get venture funding in Washington State or in the Seattle region, how many of them are getting funding from outside the state? Because I think it's quite high, actually. I think it's nothing for a VC to fly up from the Bay Area and check out a company.
There's a lot that are getting funding from outside. I had a number, and I'm afraid to say it in case it's no longer relevant this year, but a significant, not alarming, but just not encouraging, I guess, would be, are going out of state to get that funding. What I wanted to really speak to was what's happening in state. A lot of the money, a lot of the funds here are staying here, which is really important. But once again, the VCs in the Bay Area, the VCs in New York, whatever, they might be doing deals here in Seattle, but they're going to be really far away. That's another thing. One of the funds I worked with recently asked for all of our data in that so that they could see geographically how many miles were they away from all their portfolio companies, and they found the further away they were, the better they did or something, or it was their thesis. So they looked in the Midwest. They're looking at random places, but again, it depends on you. Do you want to be a hands-off type of founder? Is that really what you want when you take money from a venture fund? Or do you want a venture fund who's going to add that incremental value, who's going to mentor you, who's going to make introductions, make strategic introductions, business development? It's to each their own, right? And it's not on my plate to tell you, but the ones that are seeking the outside funding, maybe they're not getting as much support as they could be getting with a local firm.
And for the comments you said that we're doing better for companies that are farther away, could that just be the fact that they're getting better valuations on those companies because companies are so expensive?
Doing better could mean a lot of things, right? Looking at a valuation never tells the full story of how well a company is doing. WeWork, right? Any of the IPO companies, none of them were making money at the time of IPO, or most of them were not making money at the time of their IPO, right? So, but you're right, if you go inwards of the country and not on the coasts of the United States, the valuations are much lower, actually. And it's just a coastal effect, right? All the big cities are on the coasts. And so you'll see a lot of PE shops actually setting up shop in Chicago, right? In Minnesota, you see a ton of these PE middle market shops that are buying up the manufacturing space up in the middle of the country. And you're also seeing some hubs of innovation out there. Denver, for instance, right? Arizona, in Phoenix, we see Scottsdale. So you can't write off any of that at this point,
Where is international capital coming from, and is that growing in the Pacific Northwest region?
On the LP side, there's a lot of capital from overseas that is here in Seattle. There's a lot of, from Asia, right? And we see a lot of that also on the east side. We see a lot of that in the angel activity that's happening here too. I'm not super familiar with where that capital is being committed to. I know that we have a lot of wealth here in Seattle. Whether or not that wealth is being committed to a fund or being used at the angel level, we don't know, right? But we know that it's out there. I think it'd be really awesome if some of the family offices in Seattle stepped up to the plate and gave back to our startup ecosystem a little bit more. There was a lot of wealth that was made here in Seattle too, and it'd be really good to see that. But well, we'll see.
I don't disagree.
That would be that. There's a lot of money here. There's a lot of money here. Not enough is going back to the innovation side, but still, we'll see. Yeah.
That was my question that we're talking about right now. Because the Allen Institute, published the article a week and a half ago that was talking about how Seattle is positioned to be a entrepreneurial, hub, right? And the big argument was that Amazon and Microsoft and some of these big companies
lot of wealth in our area right now. So we got a lot of capital sitting around, but it doesn't seem to be translating into angel and VC type investments. Just any comment on that?
I like to think about it this way. So I know a lot of founders, and they have a lot of money, right? But for a period of their lives, however long it took them to build their companies, call it 10 years, 100% of their entire net worth was at risk put into this company, right? They put up a lot of risk to make the wealth that they have now. So now that they finally exited and they have the money, like, they probably want to play it a little less risky, right? They probably don't want to all of a sudden put it into a bunch of startups, which is just going to open up that risk, right, on their balance sheets again. So I think that's kind of what we're seeing in a way. I don't have quite figures to support that, but just in speaking to a lot of the founders here and seeing the companies that come across my desk, that's what you see a lot, because they've already had 90% risk their entire lives to make the money that they have. I don't know. Some people are more risk averse at this point, and they just want to like settle down, right? So that could be it.
There's a local counterexample on that, and that's the Bezos. Because he was an early on investor in Google. So, you know, they can do it.
Yeah. I mean, he's a special example, Jeff Bezos. I think we're running up on time here, but thank you so much for coming. This was excellent. If you have any other questions, just email me. Thank you.